Good morning. You are watching live daily market outlook for Monday, 5th of March 2012, prepared by Windsor Brokers. Continuation of the previous week's sentiment is seen on the beginning of the new week, as most of the currency pairs remained in their path at the beginning of week starting 5th of March, as euro remains under pressure, as well as British pound against US dollar. Dollar yen still in the strong ascent, but some profit taking overnight took the pair below its initial supports and currently moving around 81.20 zone. Dollar Swiss is in the recovery mode, 91.50 levels seen so far, with positive outlook for further extension higher. Gold remains flat after suffering heavy losses last week, moving still below its initial resistance at 1725, with hourly structure being completely neutral, and the pair moving sideways within a very narrow range. Crude oil also under pressure, as the recent spike at 110.53 did not manage to sustain gains, and currently trading around 106.80, with this focus still turned towards the downside. Overnight stories come as China cuts its growth target at 7.5%, with inflation at 4%. Chinese Prime Minister cut his nation's growth target to 7.5% for 2012 to basically give economy more room to slow down if needed, while the government carries out promised economic and welfare reforms ahead of looming leadership transition. Speaking at China's annual parliamentary session, Prime Minister Wen nudged down on the target from a long-standing goal of 8% annual growth, move anticipated by investors, expecting more focus on economic rebalancing and diffusing price pressures. Also from Europe, Greece rating was cut again to the lowest level last Friday, and this was expected. This was expected move from the rating agencies. And also important also to mention that Japanese Finance Minister Azumi said overnight that Japan's economic conditions are improving due to the central bank's monetary easing in February and improvements in the U.S. economy. Azumi, speaking before a parliamentary committee, also said that while the government needs to respect the Bank of Japan's independence, it needs to closely coordinate with the central bank on monetary policy and fiscal policy. From today's calendar, it just released is the Swiss retail sales that came out at 4.4% in the yearly basis, compared to, this is January reading, compared to December revised to 1.7% on the yearly basis. Good improvement. Still to come today, Eurozone final services PMI at 9 o'clock GMT, slightly better than previous 49.4 reading is today's forecast at 49.5. At 9:30 GMT, Eurozone Centix investors confidence improvement is forecasted for today -5.4 compared to -11.1 of the previous month release. At the same time, UK's services PMI, a slight decrease in the forecast. 55 is today's forecast compared to 56 of the previous month. Eurozone retail sales monthly reading at 10 o'clock GMT, no change expected today compared to -0.3% of previous month. From Americas, at 1500 GMT, ISM and non-manufacturing PMI, a slight decrease from previous month release at 56.8 is forecasted today at 56.1. Factory orders from US at 1500 GMT forecasted minus 1.3% versus 1.1% previous month release. From the technical part, we're going to take a look on the markets and see the latest movements in the markets, starting as usually with the euro. The pair remains in the down move of 134.85, double top of 24th and 29th of February, as so far retraced 61.8% of the initial rally from 129.73, 16th of February low. Negative sentiment dominates on the near-term 1 and 4 hour charts, keeping the pressure on the downside. As hourly studies show the focus at the downside. Pair this morning briefly broke again below 132 handle. That was moving around overnight, and 20 days exponential moving average just above it at 132.09, capping the upside for now. Focus on the downside is at 131 zone in case of firm break below 132, and 131.70 is the first one that has been briefly tested this morning. A clear break here to open way towards 131 and possibly levels at 130.26 and 130 on a break. Immediate barrier, as mentioned, the dynamic resistance 20 days moving average at 132.09 and the 55 days moving average at 132.59, along with the low of 1st of March at 132.81, above which is break above which is required to ease the current bear pressure and avert immediate downside risk. Clear break above 133.55 previous range floor is to refocus levels at 134 and 134.85. This is basically the previous break point low of 27th of February and also low 24th of February. So break point on the upside again is 133.55-65 zone. Cable is at the back foot after hitting a high at 159.91. So far, over 50% of the initial move from strong support at 156.50 has been retraced. It's significant at this point that pair is attempting through very strong support at 158.00, previous lows of 27th and 28th of February, with a clear break here, opens immediately 161.8 Fibonacci retracement at 157.78, and this would definitely confirm the top at 159.90, keep the focus the downside. Also significant is current, we can say now, false break above 200 days moving average. That was promising further expansion of the price action of the strong higher platform at 156.50 to possibly test 160.00 and 161.00 respectively. However, reversal below and holding firmly below 200 days moving average keeps the short-term focus to the downside. The hourly, daily studies are still in the positive field, but turning towards the downside and approaching their midlines that might signal further weakness. Dynamic support at 156.84 is the 90 days moving average, ahead of very strong support at 156.50, where also 55 days moving average stands. On the hourly and 4 hour chart, loss of 157.78 is to open the next levels at 157.20 and 157.00, again ahead of very strong support at 156.50 higher base. Dollar yen is near-term corrective mode. Currently, we can see the break below, actually a penetration of the 4 hour Ichimoku cloud, as the pair accelerated losses after losing 20 days exponential moving average at 81.60, extending so far to 81.14, just ahead of our a strong support zone at 80, 90, 80, 80, loss of which would signal a stronger reversal and would delay current positive structure of higher platform at 80.00. Basically, the main risk on the short-term outlook is seen on loss of 80 support, where the good ground was found on the recent pullback of 81.65. That might signal further corrective action. Also on the daily chart, studies are still very positive and basically moving in the vertical direction, but overextended all indicators, overextended conditions of all indicators suggest that we might see some more significant corrective action before the pair continues its rally of 76.00 base. Immediate support on the daily is at 80.00, and then we have 79.50 and 79.00 post-intervention highs ahead of 78.00, where is 200 days moving average. Dollar Swiss maintains its short-term positive tone of 89.30 base. As we can see, the Ichimoku studies are fully supportive for this move, while on the hourly chart, current consolidation was contained by 20 days moving average, and pair is now heading above 91.50 initial barrier test to test our next resistance, 61.8% Fibonacci retracement at 91.57 to open way towards more significant levels at 92.00 and key short-term resistances at 92.50, 60 and 93.00 previous range ceiling, where is also 90 days moving average and 55 days moving average currently standing at 92.60. A break above these levels is required to refocus highs at 95.73. It's also significant that the pair is currently attempting through the short-term channel bear channel resistance with sustained break here to definitely focus levels at 92, 92.50 and 93.00. On the lower time frames, crossing of 20 above 55 days moving average on 4-hour chart signals fresh weakness ahead. The studies are positive, but again quite extended, and some delay might be seen, yet no signal of any reversal. Quick look at the commodities. Crude oil remains under pressure of recent highs at 109.90 and the spike high at 110.53 posted on the 1st of March 2012, as the latest dips reached 105.80 and the current corrective action of last Friday's low has been capped by 107.27 20 days exponential moving average that keeps the upside intact for now. Crossing of 20 days below 55 days increases possibility of further extension lower, as well as the price action is attempting through the channel support that might turn immediate focus at 105.80 support and a more significant 104.83 low of 29th of February 2012. And this is actually the low of the current corrective action as the pair got capped initially at 109.90. On the upside, the immediate resistance 107.20, 107.10, where is 20 days moving average, and 107.27 static resistance, and 107.40 55 days moving average. However, clear break above 108.00, 108.50 is required to refocus levels at 109 and 110. Gold, as mentioned, stays under pressure as a recovery bounce of recent low at 1686 posted on 29th of February 2012 still remains capped at 1725 zone as 20 days exponential moving average limits the upside. With immediate targets on downside at 1704, 1701. This is also previous very strong support, and the platform where the gold price action built up the latest rally that peaked at 1790, we can see here. So this is 1700 zone is acting actually as a very strong support, loss of which is to turn the focus further lower, and below 1686 recent low to focus 1675 200 days moving average. This break of these levels to confirm the top at 1790, and the possible extension to the downside with the 1656 and 1624 seen on a break. On the upside, immediate barrier at 1725 needs to be regained. However, regain of previous lows at 17.6 previous highs, and the low of 27th of February needs to be regained in order to refocus 1790 for possible break higher. Short-term studies remain firmly bearish, while larger time frames are still in a way positive, but losing traction as momentum breaks below its midline, and the MACD is approaching the center line. From also from the near term, from the larger time frames, important levels are on the upside at 1790 and 1800, and only break here is basically required to refocus highs and record highs at 1900 and 1920, while loss of 200 days moving average might risk further extension of the larger downtrend of 1920, as this will also risk a lower top at 1790 ahead of fresh weakness. A strong, very strong support on the downside lies at 15, 20, 30 zone, where gold left the double bottom at 25th of September and 25th of December 2012. A break of these levels is to significantly weaken the longer term structure of the gold. Good luck.